welcome back to the deep dive. If you're here, it's because you want to get smart, fast. And today, we're talking about a fundamental shift in business thinking.
We're moving past just surviving, past that break-even point.
Right, where you're not losing money, but you're not really winning either.
Exactly. Today is about proactive goal setting. It's about asking, how much do we actually need to sell to hit the profit number we want? It's engineering success instead of just, hoping for it.
And we've dug through the source material on target income analysis for you, focusing on how managers use the cost volume profit framework CVP for some really critical decisions.
And to make this real, we're grounding it in a case study. Jules Corporation. They make high-end baseball gloves.
Okay, let's get the numbers down now because these are going to be important. Jules Corp sells these gloves for $200 a pop.
Mm-hmm.
The variable cost, so the leather, the labor for each glove, that's $110.
Okay.
And their fixed costs, the stuff they have to pay no matter what, like rent, that's $63,000.
And here's the mission, the target they've set. They need to figure out how many units they have to sell to make a target profit of $36,000.
Okay, let's unpack this.
So the foundation here is always the CVP equation. And it sounds a little intimidating, but it's really just common sense. Profit is your revenue minus variable costs minus fixed costs.
So if we plug in the numbers, we get $36,000 in profit equals, well, $200 times X are unknown units.
Right.
Minus $110 times X, and then minus the big $63,000.
And you see right away that 200X minus 110X, they just combine.
To 90X.
And that $90, that is maybe the most powerful number in cost accounting. It's the contribution margin.
It seems simple. It's just the cash left over per glove.
Mm-hmm.
But why is that so important for a manager to understand?
Because it isolates the real engine of the product. That $90 is the only money you have to do two things. First, it has to pay for that entire $63,000 mountain of fixed costs. And second, once that's covered, every single dollar of your $36,000 target profit has to come from those $90 contributions.
So we can almost stop thinking about the individual price and cost. We just need to figure out the total amount of contribution margin we need to generate.
Precisely. You add the two things you need the cash for. You need $63,000 for fixed costs, and you need $36,000 for profit.
Which gives us a total of $99,000.
That's the goal. We need to generate $99,000 in total contribution margin.
And since each glove gives us $90 toward that goal, it's just 99,000 divided by 90.
Which lands us at 1,100 units. That's the magic number. That's the volume they have to sell to hit their goal.
But, a manager can't just trust the math. They need to be sure. The sources really stress this idea of a verification culture. So let's double check it.
Let's do it. If you sell 1,100 gloves at $200 each, your revenue is $220,000. Your variable costs are 1,100 times 110. That's $121,000.
So revenue of $220K minus variable costs of $121K. That's our $99,000 contribution margin.
And from that $99,000, you subtract your $63,000 in fixed costs.
And you're left with exactly $36,000 in profit. Verified, it works.
It absolutely does. And it confirms that after they sell the first 700 units just to break even, everything after that is pure profit generation.
So that whole process makes perfect sense. But it also leads us to the manager's toolkit. I mean, no one wants to run that whole algebra problem every single time. They need shortcuts.
And that's what the formulas are. They're just distillations of that logic. The first one is the unit shortcut we just did. Units needed is your fixed costs plus your target profit, all divided by the contribution margin per unit.
Simple enough. But what about for, say, the finance department? They think in sales dollars, not necessarily units.
For that, we use the second shortcut, which is based on a ratio. First, you calculate the contribution margin ratio.
Okay, how do we do that?
You just take the CM per unit, $90, and divide it by the selling price, $200. That gives you 45%.
And what does that 45% actually tell me?
It tells you that for every single dollar of revenue you bring in, 45 cents is left over to cover your fixed costs and then deliver profit. It's a measure of profitability per dollar of sales.
So if we need $99,000 in total CM, we can use that 45% to figure out the total sales we need.
You got it. 99,000 divided by 0.45 gives you $220,000 in sales revenue.
Which, if you divide by the $200 price per glove, gets you right back to 1,100 units. It's a great cross-check.
It is, and top management often prefers that ratio approach
Why is that?
because it lets you compare apples to apples. If Jules Core also sold, I don't know, bats and helmets, you can't compare units of gloves to units of bats. But you can compare a 45% CM ratio on gloves to, say, a 30% ratio on helmets. It tells you where to put your resources.
That makes so much sense. It stops being about just hitting a number and starts being about strategic allocation. It informs your business planning, your performance reviews, even sales commissions.
Absolutely. You can tell your sales team your real bonus kicks in after we cross 1,100 units. It becomes a tangible, measurable goal for everyone.
Here's where it gets really interesting. Because in the real world, costs aren't stable. Prices aren't stable. CVP analysis is great, but sensitivity analysis is where the rubber meets the road.
It's so critical. You have to run the what-ifs. What happens to our 1,100 unit target if things change?
Okay, scenario one, a supply chain shock. The price of leather spikes. Let's say variable costs jump by just $10 to $120.
Okay, our contribution margin immediately takes a hit. It drops from $90 to $80. We still need that same $99,000 to cover costs and profit.
So $99,000 divided by the new lower $80 CM.
Means we now need to sell 1,238 units.
Wow. That's good. That's a huge jump. That's 138 more gloves we have to sell. That's a 12.5% increase in the sales target from a tiny cost change.
And that right there is operating leverage in action. A small shock to your variable costs can create a massive shift in your required sales volume.
Okay, let's flip it. Scenario two, a big win. They automate something, they get more efficient, and they slash fixed costs from 63,000 down to 50,000.
Right, now our total CM needed is much lower. It's the 50,000 in fixed costs plus the 36,000 in profit, so 86,000 total.
We divide that by our original $90 CM.
And we only need 956 units.
That's amazing leverage on the other side. You save 13 grand in overhead, and you cut your sales target by more than 13%.
It's the argument for every efficiency investment. It shows that trimming fixed costs has this magnified positive impact.
And last scenario is the simple one, ambition. The board just wants more. Target profit is now $50,000.
Now our total CM needed is 113,000. Divide that by 90.
And you need 1,256 units.
Right, so what this analysis does, it's not just numbers. It turns vague risks and goals into concrete sales targets. A manager can now say, look, we can handle that $10 cost increase, but only if we're confident we can boost sales volume by 12.5%.
It quantifies the trade-offs. Now, a fixed dollar target is great, but the source material really points out that investors, they talk in percentages, a return on sales. That feels like a whole other level of planning.
It's a huge conceptual shift. So let's say Jules Core's new target is a 20% return on sales.
Okay, so now the profit we want isn't a fixed number. It depends on our sales. We have to go back to the full equation.
We do. On one side, we have our contribution margin, which is $90 times X minus 63,000 in fixed costs.
And on the other side, the profit side, it's 20% of our total revenue. So 0.20 times $200 times X.
Which is 40X. So the equation is 90X minus 63,000 equals 40X.
So if you move the terms around, you get 50X equals 63,000.
And X equals 63,000 divided by 50, which is 12,260 units.
Hold on. That raises a really interesting question. We needed 1,100 units to make a fixed $36,000. Now we need 1,260 units. Why does aiming for a 20% return require so many more units? That feels backward.
It's a paradox until you reframe how you think about profit. When profit is a percentage of sales, you're basically taking a profit tax out of every single sale before you even start covering fixed costs.
The profit tax.
Yeah.
So you're saying that 20% of the $200 price,
Yeah.
$40, has to be set aside for profit on every single glove.
Exactly. So think about that $200 sale. 110 goes to variable costs. Now, another 40 is immediately reserved for the 20% profit target.
Which means out of our original $90 contribution margin, there's only $50 left.
Only $50 left per glove to cover that entire $63,000 pile of fixed costs.
And $63,000 divided by $50 per unit. That's our 1,260 units. I get it now. It's a much harder mountain to climb.
It is, and managers have to understand that when they're talking to investors. Hitting a percentage return is structurally harder than hitting a fixed dollar target because the profit goal grows with every sale you make.
This really lays out the different levels of mastery, doesn't it?
It does. Level 1 is just understanding break even. That was 700 units for Jules. Level 2 is applying a fixed target, like our 1,100 units.
And level 3 is the advanced stuff managing percentage targets and running all that sensitivity analysis to really understand your risk.
And the sources are clear on this. The shortcuts, the formulas are great, but only after you've internalized that core logic. If you just apply them blindly, you're going to make mistakes.
What are the common ones people make?
The biggest one is just forgetting to add the fixed costs to the target profit when you're figuring out the total CM you need. It happens all the time in siloed departments.
And then there's mixing up dollars and units, I assume.
Always a classic. And the last one is just forgetting to round up. You calculate you need to sell 159.1 gloves. Well, you can't sell a tenth of a glove. If you round down, you miss your target. You have to round up to 12,260.
So what does this all mean?
It means that target income analysis is a tool that turns really complex, high-stakes business problems into clear, manageable calculations. It gives you confidence in your plan.
It really creates this smooth continuum. You start with survival, which is break-even analysis. Then you move to a growth goal, which is your fixed dollar target.
And finally, you get to investor expectations, which is that percentage return target. It's the whole financial story all in one framework.
But I think the goal here isn't just about figuring out if you can be profitable.
No, not at all. The real goal of this analysis is to understand how much risk you're taking on to achieve that profit. So here's the final thought for you. We saw that Jules needed 1,100 units for the fixed target, but 12,260 for the percentage target. That higher volume target makes the company much more dependent on sales and therefore more vulnerable to a market shock. So the question is, how does knowing that a percentage goal introduces more operational risk change how a company should think about managing its costs, especially its fixed costs, in the first place?